Hello, my name is Timothy Lee Rogers Sr., and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. Inside this powerful course designed to transform your financial future, I've meticulously condensed over 1,000 of my public YouTube videos into 40 highly efficient lessons that span just 2.5 hours. This course is strategically designed into 4 phases to help guide your learning in the most logical and effective way possible. Phase 1 lays the groundwork, covering essential financial literacy like budgeting, banking, and taxes. In phase 2, you'll move beyond the basics, learning about brokerage accounts, figuring out how much you need for your own individual retirement. You learn about how to do fundamental research on companies, and you'll also learn how to conduct technical analysis by looking at stock charts. Phase 3 empowers you to build a robust portfolio and leverage your capital using advanced techniques like options and futures, and it also teaches you the importance of backtesting your strategies. Finally, phase 4 takes a deep dive into the advanced ICT concepts, giving you a professional edge. Each lesson includes a short quiz to help solidify your understanding. By the end of this journey, you'll have the confidence and tool that you need to make intelligent investing decisions, manage your money without fear or ambiguity. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here.
What's going on, everybody? I had the mic still muted. Dog tired. Just woke up. My alarm went off. My alarm went off at 5:45. My alarm went off at 5:45. I said, the devil is a liar. The devil is a liar. I'm not getting up right now. Whew. Y'all give yourself a hand for pulling up, being dedicated all February. Being dedicated all February. Let me get myself together. I'm so sorry. Ooh. Now, good evening, everybody. If this is your first time tuning in to Tim's Tidbits, please allow me to say welcome. If it's not your first time tuning in to Tim's Tidbits, I still want to say welcome. But I want to give you a nice hearty thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That just means big spot if you know hablo español. And you're tuned to another episode of Facilitation February. We are preparing to come to the end of Facilitation February. Tim, what has Facilitation February been? Well, Facilitation February, for the whole month of February, pretty much, minus the first week, we started a little late. We've been going back through my playlist, The Art of Reading Price Action, where I outlined my understanding of the ICT concepts. And we're going back through it video by video. And we're rewatching the videos together. And anytime I feel a need to give a deeper dive into the concepts, be it that Michael has given us more insight on a concept, if it's something that I have a better understanding of since I made this series a year ago, or if I feel like it's something I could have explained a little bit better, right? Or if it's something new, a new concept that he's introduced since I released this series, right? Doing a deeper dive. It's been my effort to try to help the gang get caught up to speed with the understanding of the concepts. For those that still don't quite grasp it, for those that's missing different little nuances, just my way of trying to help, bring the gang along. As a mentor, people call me a mentor. I just feel like I'm some dude from Fort Lauderdale, Florida that learned how to do something, and I'm sharing the way I understand it with everybody else. But as a mentor, I feel like, I'm always trying to find different ways to, bring clarity to the idea of trading and reading candles and understanding what price is going to do. Just always trying to bring further clarity to it. And it helps me too. The more I help you, the more it helps me. You feel me? So, yeah, man, that's what we're doing. And at the end of the video, just like always, I open up the floor for the members of the gang if they decide that they want to answer questions, right? And since tonight is the last night, I won't limit the questions to just the members of the gang that's in the Zoom chat, right? I will open the floor to, you're welcome here to learn and share. I will open the floor to everybody, even those that's in YouTube land. If you got a question, feel free to put it in the chat, and I will address it. I know initially when I first talked about it, I was like, I would address questions from YouTube if they came via super chat, but there's no need to super chat. There's no need to join the gang. If you want to join the gang, it's the second link in the description below. It's $50 a month. I think we have a good time over there. We'd love to welcome you to the family. It's not a signal service, not a trade room. I don't tell you when to buy, I don't tell you when to sell, right? We just try to figure out how to read this price action together, and we have a good time. You hear me? Tomorrow, we had our first tape reading session today at 9 a.m. Tomorrow, the tape reading session will be in the evening at 7 p.m. Eastern Standard Time. Wednesday, the tape reading session will be at 9 a.m. again. Thursday, it's going to be at 7 p.m. Eastern Standard Time. And then Friday, the last day of Facilitation February, the tape reading will be at 9 a.m. Eastern Standard Time. Tonight, we're going to talk about the market maker models. There are 3 market maker model videos inside the playlist. We're going to watch those 3 videos, do a deeper dive if I need to, and then we're going to take a break, right? And then we're going to come back and watch the Power of 3 video. Now, if it doesn't take too long doing the market maker model series, then the break will be about an hour, right? But I want to start the Power 3 video no later than 8 p.m. So it depends on how long it takes us to finish the market maker model videos. That'll determine how long of a break be in between the 2 streams. But I want to start the Power 3 stream no later than 8 p.m. Okay? Okay. While I get the video together, who we got up in here? Who do we have up in here? While I pull up the video, get myself together. Who do we have in here? That means drop something in the chat so I can see your name. Now, if you're inside the Zoom, you don't need to drop nothing in the chat. I can see you. All right. Who we got up in here? Zoom da dum dum dum. gallery. We got Valentine up in here. What's going on, Valentine? We got Steve up in here. We got Joe in here. We got Seawalk up in here. And we got Marco up in here on the Zoom side tonight. And then over on YouTube, I see we got here Learn and Share up in here. We got Honey. What's going on? Tish. I see Kim over there. That's all the names I see. I see more numbers over there than I see names, but them all the names that I see, so them all the names I'm gonna say. All right. Without further ado, let's get Felicia. What's going on, Felicia? What's happening? Yes, it did go fast. February went by very quick. It's coming to an end. All right, let me go ahead and share my screen inside Zoom. All right, share my screen inside Zoom. And let me share my screen over here. And we're going to get to it, man. Again, give it up for yourself. I'm just coming through on the whole month. And we're going to go ahead and get into it. Market Maker Models, Part 1. Let's get it.
Greetings, salutations, salutati. However you say it in your neck of the woods, I'd like to welcome you to another episode of Le Art of Reading Price Action. The market maker models. What are market maker models? MMxM's. The X can be substituted with a B or an S. That stands for market maker buy model or market maker sell model. Now, in market maker models, the higher time frame is going to provide the narrative to what price is drawing towards. Meaning, in a market maker buy model, which is the shape of a U or V, however you want to say it. I like to say U because U's are more smooth, right? In this case of a market maker buy model, the market would be drawing toward the buy stops above the initial consolidation. In the case of a market maker sell model, the A, right? The A shape, the market will be drawing toward the sell stops below the initial consolidation. Now, there's nothing ambiguous about market maker models, right? Market maker models have a very specific criteria that leads to probabilities. Once you train yourself in seeing the market maker models, you can have a clear idea where price is in the market maker model and make educated trading decisions to a high degree of accuracy, because again, it's not ambiguous. It's a very specific set of criteria that make these market maker models tick. Okay, so when price starts to trade down in a market maker buy model, this is not selling pressure that's pushing the market down. It's not selling pressure, because at this moment in time, the market price is actually bullish because the draw is the buy stops above the initial consolidation. So what's happening on the left side of the market maker model is just repricing. In another term, you can say it's manipulation, because the algorithm, aka IPTA, is repricing the market down. It's not selling pressure. It's repricing the market down to a very specific point where you can anticipate something happening. And speaking of specific points where you can anticipate something happening, gang, what do we call a specific point where you can anticipate something happening? What do we call it? That's right, an anticipatory reactionary point. So, anytime you see a market maker model, whatever's happening on the left side of the model is just all repricing, aka manipulation. So on a market maker sell model, this is just repricing down, not selling pressure. And on a market maker buy model, this is just IPTA repricing up, not buying pressure. Okay, get it, got it, good. Now, this is another crude depiction of a market maker model. Before, if you noticed, we didn't have any lines connecting the different areas of price action, consolidation, whatever you want to call it, because what happens in between those areas is not what's important. What's important is what happens at those areas, right? Now, on market maker buy models, as price comes down, right, the different areas where price pauses, those are areas of distribution. When price is going up on the market maker model and it pauses, like in these blue areas, those are areas of reaccumulation. So on a market maker buy model, you have distribution coming down and reaccumulation going up. Now, on a market maker sell model, you have accumulation going up and redistribution coming down, right? We got it? So we got distribution and reaccumulation, and we have accumulation and redistribution.
All right, I'm gonna pause it right there. The reason why I'm pausing it right there is because now I put the re on the right so that I'll understand I'm on the right side of a model, right? When I'm just thinking about price, if I just say, okay, I'm at, you know what I'm saying, at a stage of accumulation or whatever, right? And it's just for personal. I don't always say this whenever I'm talking about it, but I understand that I'm on the left side of a market maker sell model. But if I say reaccumulation, if I'm talking about reaccumulation, then that lets me know I'm on the right side of a market maker buy model. So it can help me just identify, because it's just first stage accumulation and first stage accumulation, second stage reaccumulation. That's how Michael teaches it, right? But I always just say reaccumulation to let me know re is on the right. All right. And then for the market maker sell model, you will have first stage distribution, second stage redistribution, right? But I just like to say redistribution to let me know I'm on the right side of the market maker sell model. And another thing to always remember, your market maker models aren't going to look cookie cutter like this. It's not going to always be one stage of accumulation, two stages of distribution, or two stages of accumulation and two stages of distribution. There's not going to always be so symmetrical where you got the same amount of accumulation and distribution on each side. It's not going to always look just like this. You're looking for the whole idea behind market maker models is that you're looking for the initial consolidation, the manipulation to a very specific point, and then coming back and completing the market maker model. So you're looking for the accumulation, manipulation, and distribution, right? Get it? Got it? Good.
Have accumulation and redistribution, right? Understood? Now, do not get confused with the price engine model of reaccumulation and offset reaccumulation. That's a price engine model that's named the same thing, because in this area of distribution, you can be looking for a price engine model of offset distribution or redistribution inside this area of distribution. You can look for an example of offset accumulation or reaccumulation inside this area of reaccumulation. So don't confuse it with the price engine model and what's happening during the market maker model. So just understand, on the right side, add re. It's re on the right, reaccumulation and redistribution. Left side, accumulation and distribution. Right side, reaccumulation and redistribution. Get it? Got it? Good. Why is this a buy model? because the sentiment is bullish. Okay, I know you may say, Tim, if the sentiment is bullish, why is it going down first? Because as we've learned throughout the mentorship, if you are bullish, you want to see IPTA manipulate price down first to attack the sell side to the downside. And then you want to see it attack the buy side. So the sentiment is bullish and you have the initial consolidation. So as soon as the market gives you an indication that it's moving down, such as coming down to this area of distribution, you may get a draw back to the initial consolidation like you do in this case, and then you may not. It may just continue to sell down. It may not be an offset distribution. It may just be a redistribution pricing model in this area of distribution. But once you get all the way down to your anticipatory reactionary point, you're going to be looking for the smart money reversal. What is the smart money reversal? The smart money reversal is when price reaches a point that should provide, and in this case of a buy model, significant support. So when you get your anticipatory reactionary point, you will be looking for price to be supported, and then start to trade back up. And once it starts to trade back up, then you will get your opportunity for reaccumulation and move all the way back up to your draw on liquidity. The same for a market maker sell model. What makes this a market maker sell model? Because at this point in time, the sentiment is bearish. And so the draw would be the sell stops resting below the initial consolidation. And when price starts to move away and start to move into the first, second, or however many stages of accumulation, you will be looking for a time when you reach your anticipatory reactionary point and the market gives you a smart money reversal. In the case of a market maker sell model, the smart money reversal will be a level, a price, an area, if you will, that's anticipated to provide significant resistance. And once you hit this area of significant resistance, then you would look for the market to reverse and go into your first, second, or how many stages of redistribution, coming back down to attack the sell side below the initial consolidation. Now, like I say, this is just a brief introduction to the market maker models. Just get your eye used to seeing the market maker models. We will take a deeper dive as time goes on. But for now, I want you to go through your charts and go through the 15-minute chart, right? And I want you to squanch your chart up, squanch it up, squeeze it up so that you can see the larger price moves more easily. Just squanch it up so you can see the large price moves, the swings, the large swings moving. And then I want you to identify the market maker models that you see, right? On the 15-minute time frame, and using the ES continuous chart on TradingView, that's ES1 exclamation point, and take detailed notes on what price did during those models. Do it for market maker buy models, do it for market maker sell models, and take copious notes on what price did. Now, the mentees be like, Tim, I don't have examples of what to do, so when I go do the homework, I get lost sometime. I want you to go and get it on your own. I want you to learn to fish. But I'm not going to just leave you high and dry. I'm going to give you some examples. Pull it right from Michael's slides, right? Here is some price. I want you to squanch. This is what I mean when I say squanch the chart up. Squeeze it up so you can see the moves more easily, right? I want you to do it on 15-minute time frames, right? And then you can identify, hey, there's a market maker buy model. There's a U. There's a U. Oh, look, there's a market maker sell model right there. I see an initial consolidation, goes up, comes back down below that initial consolidation. There's a market maker sell model. And then you go through and you take notes. This is some example of some notes that Michael took on his market maker sell model here. Your initial consolidation, as you see there, he has it. It says the draw on liquidity, sell side right there. That's your initial consolidation. Price went up to what? This high over here, this buy side liquidity, that was his anticipatory reactionary point. And then the market reversed, and then we came back down, got our redistribution over here, an area of redistribution. Want to pause it right there and interject, right?
the smart money reversal is always going to be at some level of liquidity, right? It can be at a daily liquidity, a monthly liquidity, a session liquidity, a hourly liquidity, right? It's going to be some level of liquidity being taken at the smart money reversal, because the smart money reversal is where smart money is buying from willing sellers at a deep discount, or selling to willing buyers at a deep premium, right? Above old lows or old highs, respectfully, right? So you may be coming up into a daily fair value gap where you're anticipating price to reverse, but on some level, there's going to be some liquidity being taken. You may be going down to a bullish breaker, but there's going to be some level of liquidity that's being taken, because the smart money reversal is always going to happen at some level of liquidity, right? And then you're going to be looking for the obvious draw on liquidity on the opposite end, like these relative equal lows here. In this case, from this initial consolidation there, went up above buy side, right? And then came back down. Okay.
And then we came back down below the sell stops, completing the market maker sell model. So this is an example of how you can annotate it however you want, but use all the things that we've covered in the past, from open, high, low, close, to fair value gaps, to breakers, to order blocks, whatever you want to annotate on the charts. As much as you can remember, just annotate how the price moved throughout these market maker sell and market maker buy models. Now, with that brings us to the end of another episode.
All right, gang. Any questions from you all before we move into video 2 for the market maker models? Any questions? Also YouTube, any questions before we move on to video 2? Remember, the market maker model, it encompasses everything, right? I feel like the market maker model is like what the ICT concepts are all about. Just like the power of 3. The power of 3 is what the ICT concepts are all about. And the market maker model is a good visual representation of the power of 3, right? You got the accumulation, the manipulation, and the distribution. Okay. Don't see nothing in the chat. Don't hear nobody saying anything. So we are going to move on. So, all right, carry on.
Somewhere just on the second Sunday, talking about market maker models. The first thing you need to do is stop looking for patterns. Please stop doing this. Stop looking for patterns. Yes, I know, just like every other ICT concept, the market maker model looks like a specific pattern that you want to see setting up. But you are not trading patterns. All of the ICT concepts are based off of narrative. What is price doing? What is price drawing toward? What is the draw on liquidity? It's not about the patterns. Stop looking for patterns. Please stop doing this, right? Remember, what do we say in part 1 about the market maker models? Market maker models is a very specific criteria that leads to probabilities. Remember that? Remember that from part 1? It's a very specific set of criteria that leads to probability, right? What is this criteria? What is going on? IPTA will engineer liquidity and then it will reprice to a very specific price point. Then it will reprice back to that target liquidity. And while it's doing this the whole time, it's just offsetting hedges. Now, you got to understand, with IPDA, everything is a hedge, right? They will manipulate price or reprice up in a market maker sell model to reprice down and offset those long hedges as they're coming down to the target of the sell side. Right. Let's get a visual involved. The market maker buy model, right? The market maker buy model. So we all know we realize, most of us, myself included, we realize we're in a market maker buy model when IPDA gets over here. When we get to this portion of repricing, I don't know why I'm doing my hands like this, but when we get to this portion of repricing, then we realize, hey, I'm on the right side of a market maker buy model. But the whole time, IPDA started here in this initial consolidation. Right? What do we say about consolidation? We say that IPDA is generating liquidity when it's consolidating. Okay, so if it's generating liquidity, it's allowing liquidity to build on the top, buy stops, and on the bottom, sell stops. And then if our overall higher time frame is bullish, right, and IPDA starts to reprice down, it's engaging the sell side, repricing down, so it's selling now. IPDA is selling down to a very specific point. And what do we call this very specific point? An anticipatory reactionary point. At this anticipatory reactionary point, IPDA will perform a smart money reversal and start to reprice higher. Like I said, this is when we typically realize, hey, we're in a market maker buy model, because we don't know how far down or how far up in the case of a market maker sell model that IPDA is going to push price. But when we get the smart money reversal, we realize, oh, we're in a market maker sell model in this case. And it reprices back to the draw on liquidity, because in this case of a market maker sell model, at this initial consolidation, the higher time frame bias was bearish. So IPDA repriced up to a very specific point, an anticipatory reactionary point, had a smart money reversal, and then repriced down as they were offsetting their hedges. Everything that they bought going up, as they came over here on the right side of the sell model, they are offsetting hedges, right? They're offsetting hedges. Wherever it paused to accumulate more longs over here, it will pause over here to offset those longs on the right side. And in the case of a market maker buy model, anywhere that it paused to take on more shorts, it will pause to offset those shorts to attack the buy side liquidity in the market maker buy model. So everything about the market maker model has a very specific set of criteria that's leading to probabilities. So we should not be looking for patterns. Please stop looking for patterns everywhere. Okay? And if you don't remember anything else about this video, matter of fact, I'm going to go full screen to say this. Market maker models are not reversing patterns. Let me say that again. Market maker models are not reversing patterns. Now, they can be a reversing. It can form at a reversal, but they are not reversing patterns. Please do not try to predict reversals. Don't try to pick tops. in bullish trends. Don't try to pick bottoms in bearish trends. Market maker models are not reversing patterns. It's a very specific criteria that leads to probabilities. Get it? Got it? Good. Now, we all know price is fractal, right? Price is, so when looking at price, it matters not what time frame you're looking at when you're studying price. The time frame does not matter. Price is fractal, right? So many people get caught up in what time frame, it doesn't matter. I can't tell you what time frames are going to work best for you. It's up to you to figure out your trader identity to identify what time frames work best for you. But when you're studying price, you're not looking for patterns. You're studying what price is doing. What is the specific criteria that's leading to these probabilities? That's what you want to identify. Now, looking at this line chart here, we can all agree that this appears to be a large market maker buy model. We can all agree to that, right? But let's just say that this is a higher time frame market maker buy model. Right? What else do you see here? Right? Would you believe me that when I told you that in every retracement here, there's a market maker model in every single retracement on this line chart that you see right here? Because that's true. On every retracement, there's a market maker model on a lower time frame. What lower time frame is it? Who cares? It can be a bullish or bearish retracement. Every retracement you see, there is a market maker model on a lower time frame. Now, like I said, don't be looking for the patterns. It's about the narrative. Because with this market maker buy model here, what else do you see here? Right? There's also a bunch of market maker sell models. For example, here's one. There's a market maker sell model right there. There's a market maker sell model right there. Right? There's a market maker sell model inside this retracement here. On a lower, market maker models are in every retracement. Not only are there other market maker sell models inside this market maker buy model, there's smaller market maker buy models inside the larger market maker buy model. Because price is fractal. Price is fractal. What happens on the lower time frames bleeds into the higher time frames, bleeds into the even higher time frames. Price is fractal. How do you train yourself to use the market maker buy model if it's not looking for a pattern? I'm glad you asked that question, right? You ask yourself, what is price telling me? What is it telling me? If my higher time frame is bearish, okay, are swing highs being respected? Are swing lows being disrespected? If swing highs are being respected and swing lows are being disrespected, if premium PD arrays are being respected and discount PD arrays are being disrespected, if up close candles are being respected and we're continuously pushing through down close candles, then we may say we're in a sell program. And what's the opposite of a sell program, gang? What's the opposite of a sell program? Correct, a buy program. So if your higher time frame is bullish, then you would want to see that price is in a buy program, meaning you want to see swing lows being respected and swing highs being disrespected. And if you're wondering, what are all those circles on the chart there, Tim? These are short-term swing lows and swing highs. That's marked out, right? You have short-term swing lows and swing highs. So if you're in a sell program, you will want to see short-term swing highs holding and short-term swing lows giving way, meaning we're displacing through the swing lows, but we either don't get to the swing highs or we quickly manipulate them and reject off. And in a buy program, you want to see the short-term swing lows holding and the short-term swing highs being disrespected or displaced through. So if your higher time frame is bearish, right, you should be looking for sell programs. Right? You should be looking for sell programs. And if you're looking for sell programs, you're looking for opportunities to sell. So in this market maker buy model, if you are skilled enough, you can find opportunities to sell on the sell side of the buy model. Now, Michael teaches it to only trade in accordance with what the model is, meaning on the right side of the model, right? Meaning on the right side of the model. Why is that? This isn't per him, it's per me. Because if you're trading on the right side of the model, right, you're doing what this model at this specific point in time is seeking. You're seeking opportunities to buy if you're operating on the right side of the model, right? So a market maker buy model is designed to draw towards buy stops. The market will manipulate down, will reprice down to a specific point, as we call an anticipatory reactionary point. And then it will reprice back up to engage the buy stops that were engineered at the original consolidation. If the market is in a sell program and if the higher time frame is bearish, then it would just be the reverse. It would just be the reverse. Now, here's one little tidbit to not get sucked into looking at the lower time frame and changing your bias or changing your narrative based off the lower time frame. Okay? Not only do you have short-term highs and lows on this chart, we also have something called intermediate highs and lows. That's where the blue marks are, right? Those are intermediate highs and lows. So if you are in a sell program or a buy program, if you ever take out an intermediate high or low, you can anticipate a larger pullback. For example, right, as price in this market maker buy model, as price made a smart money reversal here, had a low risk buy here, started to move up. We came to our first area of reaccumulation. As we moved up, coming up here into our second area of reaccumulation, we took out an intermediate term high. After taking out that intermediate term high, if you notice, we had a larger retracement. We came down, created a short-term low, took that out, and traded below a short-term low there. And in this larger retracement down, what do we have there? That's the area where we saw our example of a market maker sell model. That market maker sell model developed inside this larger market maker buy model because price had taken out an intermediate term high, which created a larger retracement. So you know that you're in a market maker buy model and you haven't reached the draw on liquidity. So if on a lower time frame you start to see a larger retracement, don't reverse your bias. You only reverse your bias if you get a reason to on the higher time frame. And as you see, we took out an intermediate term high on the higher time frame, signifying, yes, I want to keep going higher. And we didn't take out an intermediate term low on the higher time frame. We only took out a short term low. that was already created. These short-term lows that were being created on this retracement, those was just casualties of war of coming back to trade below a short-term low in this price lead that had taken out an intermediate term high. So don't get caught on lower time frames and reverse your decision making based off the lower time frame. Remember, the market maker models are very specific criteria that lead to probabilities. So make sure you identify all the clues that price is giving you as it's moving away from and towards the draw on liquidity. Now, that brings us to our favorite part, le homework. I want you to go back through price. Right? Go back through price and take detailed notes of what price did during market maker buy and market maker sell models. You pick the time frame. It matters not to me what time frame you pick, but make sure you just go back and identify on the ES continuous contract, ES one exclamation point on TradingView, but the ES continuous contract, you pick the time frame. Just make sure you identify clear market maker buy and market maker sell models and take detailed notes on what price did on the sell side of the curve and on the buy side of the curve for market maker buy models, and on the buy side of the curve and on the sell side of the curve for market maker sell models.
All right, market maker models part 2. I ain't gonna hold y'all. I wasn't in here for the majority of that video because I was helping my son get his live stream together. him and his girlfriend back there working on some content for, well, I don't know if it's a live stream or video. I think they're doing a video. They're not live streaming, they're doing a video. But I was back there helping him get something set up with the camera, and I wasn't in here for most of that video, but it sounded like I was cooking. So hopefully it helped y'all out a lot. Hopefully it helped y'all out a lot. Do we have any questions? Just being transparent with y'all. Y'all know I'm a straight shooter. Do we have any questions after watching part 2? And also with the homework, you can pick any instrument you want to pick. It can be the ES, it can be the NQ, it can be Google, it can be whatever you want to pick, because price is price. All right. Do we have any questions from the gang, and do we have any questions from YouTube before we get into part 3 of the market maker model series? No questions? All right. Let's continue. Who in here? Who we still got in here? Y'all drop some. Do me a favor. Hit a like for the algorithm. Hit a like for the algorithm. If you're not subscribed to the channel, please subscribe. Also, give yourself a round of applause. Give yourself a hand. That was for YouTube. I keep forgetting that I have to reshare my sound if I'm not sharing my screen. So gang, y'all give yourself a hand. Also drop me the please bombs for yourself. You know what I'm saying? And putting in the effort to further your understanding of re and price. All right. Now let's move on, man. Y'all acting real quiet tonight. Market maker models. After market maker model part 3, we're going to take a break for roughly an hour, and we're going to start the last video of the series, The Power of 3. I say roughly an hour because it's 6:52 right now, and I want to start the last video no later than 8 o'clock. It's going to be a separate stream. We're going to end this stream, start a new stream at 8 o'clock. All right. Market maker models. part 3.
Greetings, salutations, hazim in my stat, however you say it in your neck of the reading price action. Turn your attention over there, please. Over there, on that side of the screen, not on me anymore. Over there. Now, this is Market Maker Models Part 3. And we will be discussing the reclaim block. Now, there's 2 different ways that Michael teaches the reclaim block. And this episode, we're going to be talking about the reclaim block in reference to market maker models, because that's what we're on. We're on market maker models. Before we go on, I want to reiterate what I said in part 2 of the market maker model series, that we should stop looking for patterns. We're not looking for patterns. The market maker model is a specific set of criteria that leads to probabilities. And we also know that during this market maker model, IPTA, the algo, aka the market maker, will engineer liquidity and then reprice to a very specific point. And we like to call that point an anticipatory reactionary point. Then it will reprice back to the targeted liquidity while offsetting hedges. Right? Remember, it's all about the hedges when it comes to big money. If you got big money like IPTA, if you got big money like these institutions, you have to hedge. You have to hedge into your positions. Now, let's get into it. Let's look at a market maker sell model first. As we know, with a market maker sell model, we got a sell side on the left and we got a buy side on the right of the market maker model. Now, first thing you want to do with market maker models and any concept dealing with ICT, you want to make sure you have a clear draw on liquidity, right? This lets you know when you're supposed to be looking to the left. Everything you need to know is always to the left. It's always over here to the left. But if you have a clear draw on liquidity, you understand when you should be looking to the left to find these reclaimed order blocks that we're going to be talking about. Right? Now, when you're speaking of the big money, IPTA, you got a lot of cash. I still don't know why I'm doing my hands like this. But big money, you got a lot of cash. They can't place their orders in one trade. They can't place their full order in one trade. They got to scale in, right? How do they scale in? They scale in by doing something known as hedging. In a market maker buy model, the bias is bullish, right? The bias is like, you want to have a bullish bias when you see a market maker buy model developing. But before it attacks the buy side liquidity, right? Before it will engineer liquidity and before it attacks that buy side liquidity, IPTA will reprice down to a very specific PDub rate. It's already predetermined how far IPTA will reprice down. It knows how far it has to go to allow itself to scale in to all the positions that it needs before starting to go back up. So it's already predetermined how far it will go down, right? So when IPTA wants to get long, or when institutions want to get long, the market maker, aka IPTA, will start to reprice lower. And as it's repricing lower, it will start to hedge into long positions, right? It will start to create bullish order blocks on the way down. Tim, what are you talking about? Let me show you, right? When you start to see these bullish order blocks forming on the sell side of the curve and price is bullish, right? You're not getting tricked into trying to go long over here when you see little pops. Like the pops is a indication that hedging is taking place. Right? So as we're coming down and you see a down close candle that creates a pop, a short-term displacement, this is evidence that hedging is taking place. IPTA is going, now, mind you, it's not going to just be 3 times down every time, right? It's the narrative. We're not looking for patterns. So if you're bullish and you see price consolidate and engineer liquidity, and then it starts to reprice down, right? And you're bullish, you're focusing on the liquidity above that initial consolidation. And as price sails down, when you see down close candles start to create short-term displacement, creating a short-term low over here, it creates displacement. That's evidence of IPTA hedging into long positions. That's why you get that little short-term pop, that short-term displacement, right? Informed traders that's more advanced, this is when they take advantage of what they call selling the rip, right? You don't want to be buying a dip over here on the sell side of the model when you're bullish, right? When you see that short-term displacement, don't make the mistake of buying a dip when you're on the sell side of the model. How do you know if you're still on the sell side of the model? Because you haven't reached your anticipatory reactionary point. You haven't reached your higher time frame PDub rate. You haven't reached that breaker, that bullish breaker. You haven't reached that bullish order block. You haven't reached that old low, that old equal lows, or that old swing low. You haven't reached that higher time frame PDub rate. But once you reach that anticipatory reactionary point, you would get a smart money reversal and price will start to go back up on the buy side of the curve. Now, let's see the definition of a reclaimed bullish order block. Bullish reclaimed block is a candle or bar, just say candle, we don't look at bar charts, that was previously used to buy price in a short-term bounce confirmed minor displacement. Remember I told you, when you see that short-term displacement, that's your clue that they are hedging into long positions. Again, right? It's a previous candle that was used to buy price in a short-term bounce confirms minor displacement. When you get to the buy side of the curve, right? These, when you look to the left, on the buy side of the curve, these old blocks will be used to reclaim long positions. So they're scaling into longs, scaling into longs, scaling into longs, smart money reversal. And then when you start going up on the buy side of the curve, reclaim the order block, reclaim the order block, reclaim the order block. So how do you identify it? When price moves back above the old bullish order block, so the old down close candle that caused a displacement, when price trades back above that on the buy side of the curve, you look for price on the buy side of the curve. When it trades above the bullish order block that's on the sell side of the curve, you look for price to trade back down into this down close candle over there to reclaim longs. And price will do this or reclaim these order blocks until it reaches the draw on liquidity. Now, Tim, you said a whole lot, and you're showing me this little victory V shape here. What does it look like on the chart? It looks like this, right? You identify a market maker buy model, right? Look at a market maker buy model. See, we're in a market maker buy. You identify the market maker buy model. And when you identify the market maker buy model, you want to... I'm sorry to pause that on y'all, but I think it was raining when I was making this video, because I done got up twice and going looking outside because I keep hearing thunder. But that's the thunder that's in the video. Carry on. Split it in half. Now, this is when you're studying. So when you're studying, you want to split it in half. And then you want to look at the buy side of the curve and look back at whenever the buy side of the curve pulls back with a move like this is go up and pull back. Look to the sell side of the curve to see what is it reacting to. When we went up, what did we react to? When it went up, what did we react to? Look over there. It's reacting to bullish order blocks. It's reclaiming bullish order blocks. When you have a down close candle over here that created a pop, it's trading back down into the down close candle and reclaiming longs. It's trading, it closed above, traded back down into the down close candle, right? Reclaiming longs until it pushes up until it. All right, I'm gonna pause it right there. I'm not sure if I say it in the video, all right? Not sure if I say it in the video, but you're looking at the last down close or the last up close for the bearish side, right? So if we look here, right, we see we got consecutive down close candles over here, right? But you're focusing on that last down close, right? We got a couple consecutive down close candles here, but we're looking at that last down close candle, right, where it created some type of short-term rally. In this case here, we came down, short-term rally, came down, short-term rally, right? We're looking at those order blocks that created those short-term rallies. So when you get on the buy side of the curve, right, once you close back above the order block, now you're looking for price to trade back down in and reclaim that order block. Is it going to reclaim every single order block? No. It might reclaim every order block in a market maker buy model, and then it may not. It just depends on how fluid price is moving, how much of a low resistance liquidity run it is. But like I say, we're not looking for patterns. We're looking for the probabilities. We're looking for the highest probabilities into the draw on liquidity. Those are bullish reclaimed order blocks. Now moving on to the market maker sell model. It's pretty much the same. It's just in reverse. So we'll go through it quickly, right? Relatively quickly. You got to have a clear draw on liquidity. You got to understand that price is truly bearish, right? When you start to look to see if a market maker sell model is forming, you want to see a consolidation, an initial consolidation, and then price start to reprice up towards an anticipatory reactionary point. As price reprices up to an anticipatory reactionary point, it will start to create bearish order blocks or up close candles that create a short-term high, pushing price down for a minor displacement to the downside. So as it goes up to the anticipatory reactionary point, you'll have a smart money reversal, and then as we start coming down the sell side of the curve, it will start to reclaim those order blocks for short positions. Now let's look at the definition. Bearish reclaimed order block is a candle or bar, we just talk about candles, we don't look at bar charts, that was previously used to sell price, and a short-term decline confirms minor displacement. In the sell side of the curve, right, that's over here, and the sell side of the curve, these old blocks will be reclaimed for new shorts. So as price trades down past the old up close candle that created the short-term drop in price, price will trade back up into those up close candles to reclaim shorts. Drop down past these old up close candles that created a drop in price, and it will trade back up into those up close candles to reclaim shorts. Now let's look and see how it look in price. It looks like this. So you want to, as you're studying, again, you want to focus on the market maker sell model. You're looking, for an obvious market maker sell model. You want to split it in half, right? You split the model in half, and then you see on the sell side of the curve, whenever price came down and retraced back up, you want to look over to see what was it reacting to. When price trades down and it reacts back up, what was it repricing to? Okay, it was repricing to this. If you notice, as price came down below this up close candle that created a drop, right? As it went below it, it traded back up into that up close candle. As price traded down below this up close candle that created a drop, it traded back into that up close candle on the sell side to accumulate more shorts. And then when it traded below, you get the picture. It accumulated more shorts until it went down to the draw on liquidity. And that is the market maker sell model. Now, for our favorite part, let home work. I want you to go back through price and take detailed notes on what price did during market maker models. While the thunder roars in the background, y'all see the homework. Like I say, you can do the homework on any instrument that you choose. Let me get closer to the mic because I know the other day y'all was like, Tim, you keep getting low. You keep getting low. So hopefully you're not having any troubles with hearing me. You can use any instrument that you want. I choose to trade only the NQ now. This is back when I was trading the ES when I made this video, but I only trade the NQ now, but it's all the same. It works the same on anything with price action. Okay, if you only trade stocks, if you only swing trade stocks, if you only trade options on stocks, if you only trade options on indexes like the SPY, the SPX, the QQQ, whatever, SMH, whatever instrument you trade, all of this works. Okay, again, don't be looking for patterns. I think I did a really good job with the market maker model series here as far as providing enough detail. The only thing I wanted to interject is that you're, for the reclaimed order blocks, you're looking for that last up close or last down close candle for the reclaimed order block. Yeah, that's it, man. Do we have any questions from the gang or from anybody in YouTube land? Right? If you're still here on YouTube, do me a favor, man. Hit a like for the algorithm. If you're not subscribed to the channel, please subscribe. Did I stop sharing my screen with Zoom? No, I didn't. There it is. All right. Now I stopped sharing my screen. I don't see anything in the chat from YouTube. Gang, y'all got anything? It's 7:10. So if there's nothing else, we're going to go ahead and call it here for this stream. And we're going to go. Man, what's going on with my watch, man? Hold on. My watch is tweaking. All right. We're gonna go ahead and call it for this stream. We're gonna take a break. Y'all go stretch your legs, get something to eat, take a shower, whatever you're gonna do, get comfortable. Then we're gonna come back at 8 p.m. and finish off the series with the power of 3, and then finish out the rest of the week with only tape reading. All of the educational part of it will be out of the way. All right, so we're gonna come back at 8 to look at the power of 3 video, and then tomorrow the tape reading will be in the evening. So the tape reading is going to be at 7 p.m. Eastern Standard Time, and we're going to be watching the NQ. And then Wednesday morning, we're going to do tape reading at 9 a.m. Eastern Standard Time. And then Thursday, we're doing tape reading at 7 p.m. Eastern Standard Time. And then Friday, we're doing tape reading at 9 a.m. Eastern Standard Time. We're trying to give everybody an opportunity to be able to watch price in real time and look for the signatures in real time, be it if you work 9 to 5 and you can't make it in the 9 a.m. sessions, or if you work in the evening and you can't make it to the evening sessions. We're trying to give everybody opportunity to get a chance to tape read and see it live and live in color. All right. Again, we're going to take a quick break, be back at 8 o'clock to do the power of 3. For those that's watching the replay, I appreciate y'all for tapping in. Right. Matter of fact, drop one
Let me share my sound with y'all on Zoom so y'all don't feel left out. Drop one of the clues bombs for yourself, pulling up and taking the opportunity. Also, give yourself a round of applause, man. So, taking the effort to sit down and want to, learn a little bit more about how to read this price and how to build a new Wakanda together. You hear me? All right, man. Till the next time I decide to get on Al Gore's internet and share my thoughts on this thing called price action. This is for everybody who watching the replay. The rest of y'all that's here live, I'll see y'all at 8 o'clock. But for the rest of y'all, until the next time I decide to get on Al Gore's internet and share my thoughts on this thing that we call price action, it's your boy, Timothy Lee Rogers Sr., a.k.a. Aranya Grande. You see it behind me. You see it on my shirt. That just mean big spot if you don't hablo Espanol. Y'all be safe out here in these trade streets, man. Gone.